Hello, everybody. Welcome to part 2 of planning with section 199A, section 678 trusts, and complex trusts. We welcome you to this presentation. It's not going to be a very good presentation, but it's going to be better than most because today the primary presenter, Brandon Ketron, is really on the top of his game. Brandon, while not as tall as Alan Gassman, is very, very smart and has a fantastic memory. He's also willing to work Saturdays. So we welcome you and we will begin the presentation. If you have anything better to do whatsoever, go do it. And we'll tell you what happened later. Thank you. All right. Here we are, ready to go. Please note our email addresses on your screen, brandon@gassmanpa.com. Please send Brandon the hard questions. I'm gassman@gassmanpa.com. Please send me the easy questions. This is a CPA Academy approved presentation, which means that if you are a CPA or a registered practitioner and you want credit and you came in through their website, you'll answer at least 3 of the 4 polling questions, and then you'll get your credit. If you came in through our website, you get no credit. And sorry about that. So please check out our YouTube video on how to handle hurricane damages. Now this involves the East Coast of Florida as well. So if you have friends, loved ones, or clients who have hurricane damage situation, we do recommend this webinar, which is free of charge and there's no continuing education credit for it. So, Brandon, where do you want to start?
Let's start with, well, let's just start here. So we do have some updated slides throughout this webinar here, and we recently updated our employment tax summary chart to be for 2022. We also have the 23 numbers on there, and then a nice little handy desk reference for you to talk about just exactly what it would cost you as far as employment taxes go to put someone on the payroll. The other way you can use this chart, as we'll get to with some of the planning, is how you can save employment taxes by maybe having an S corporation with the salary paid versus a partnership where all income is subject to employment taxes. So this is just a nice reference to have what it costs you, what it costs the employee, and if you're self-employed, the double hit there and what it costs you for those items as well. So to start off with, I just want to, I know this is part 2, but I want to start back from the beginning and just give a brief refresher of exactly what we're talking about here for section 199A. What we're talking about is a deduction on what they call qualified business income, or QBI for short. It's a 20% deduction. So if you have $100,000 of income from a qualified entity, you would only pay tax on $80,000 of that income. Just a simple example there how 199A deduction works. There's a lot of rules around it. There's some threshold limitations depending on your level of income and the type of business that you're in. But mostly this comes from flow-through entities. That's S corporation income, partnership income, Schedule C income, rental income on Schedule E, as long as it's an active trader business, which we'll get to, farm income, and then if you have taxable income in a charity, that could also qualify under some of the regulations that were published. Now, there's some important rules that you need to know and understand. Number 1 is it has to be an active trader business in order to qualify. If you have just a simple triple net lease and you're getting income on a Schedule E, don't really do any maintenance, don't really do any work on the property, you just collect the rent, that's not going to be a business that qualifies. It needs to be more active than that. So there's no real test, but there's a lot of case law that gives us guidance as to what is a trader business. You can tune into part 1 and we talk a little bit more about what a trader business is. Okay, so then on the next slide, slide 26, we have just a summary of really the two main rules you need to know and be aware of with Section 199A. And this is where a lot of our planning is going to come in. The first limitation is a specified service trader business limitation. So if you're one of the tainted industries, health, law, consulting, accounting, if you are a famous person and you're getting licensing income, that's not going to qualify. We have a slide that lists them all out, but those are some of the main examples. If you're one of those businesses and your income exceeds certain thresholds, then you don't get the deduction. There's also a phase out range where you would get a pro rata amount of the deduction. But let's say you're a married taxpayer, you earn $200,000 of taxable income each year, and you're an attorney, which is one of the specified service trader businesses. Well, you're under that threshold of $340,000 for 2022. So there's no limitation. You get the full deduction. It also doesn't matter what amount of wages you have or the amount of qualified property you have. You're under the threshold, so you simply get to take a 20% deduction on your qualified business income. Now, if you're over $440,000 of income, so if you have $500,000 of taxable income as an attorney, then you don't get the deduction at all. But what you could do is maybe shift some of that income to your children or other family members that are below the threshold, and they can qualify for the deduction, particularly if you don't necessarily need the income, which can be good for income tax planning and also good for estate tax planning. So we'll get some examples as to how that works. The second test, and this applies to all businesses, regardless of whether you're a specified service trader business, is that if you're above those income thresholds, you have to have a certain amount of wages paid to get the full deduction, or a certain amount of qualified property to meet the requirements to take the full deduction. So for example, just to keep things simple, if you have income of $100,000 and you're going to take a Section 199A deduction of $20,000, you would have to pay at least $40,000 of wages in order to qualify for the full deduction, because the deduction is limited to 50% of the wages paid by the entity. And if you don't have enough wages, you don't get the full amount. If you only paid $10,000 in wages, then you would only get $5,000 of deduction. So there's a lot of planning involved there, making sure the right amount of wages are paid. Sometimes you don't want to pay too much because that would then reduce your qualified business income deduction. And sometimes you're not paying enough and you would need to pay more. So that's something you can look at with your clients, make the determination of where they need to be as far as wages paid. Now, for the capital intensive entities that have a lot of property and maybe not a whole lot of employees, there's a second test where you can add up 25% of your wages or 2.5% of your basis and qualified property. You take that total, and that is your deduction limitation. If it exceeds your deduction, then you can go ahead and qualify for the full deduction. If it's less, then there is a limitation that applies. But again, remember, the big thing here is if you're below the thresholds, you don't have to worry about any of these tests and you can take the deduction. So how do we get into those lower thresholds and shifting income to other lower bracket taxpayers is what we're going to be mostly talking about here today. So Alan, any comments on the initial background?
No, well said.
All right, so I think that takes us now to our first poll.
So the Section 199A deduction, the answer here, by the way, is D, all of the above. But the question is, does it apply to income from certain active trades or businesses? Does it apply to income from flow-through entities? Is it subject to limitations depending on types of business and the income of the owner? And the answer is, surprise, surprise, D, all of the above. D is also for dog, bark, bark, bark. Okay, thank you very much. Back to you, Brandon.
All right. So to skip forward a little bit, we covered a lot of this in part one, which I believe is probably posted to YouTube if I'm guessing correctly, or you can probably find it on the CPA Academy archives as well. And so you'll see some of the slides we'll skip or covered there, but just to touch base on this one, this is your specified service trader businesses. or the no good businesses that don't get the full deduction. It includes health, law, accounting, actuaries, performing arts, consulting, any athletics, financial services, so your CFAs, financial planners, brokerage services, dealing, investing, trading in partnerships or securities or commodities. And then number 11, a lot of us were worried about because it seemed to be a pretty broad catch-all with where the principal asset is the reputation or skill of one or more of its employees or owners. Thankfully, the final regulations that came out on 199A really limited this to be more of a catch-all for people that use their name, image, and likeness for receiving revenue, such as, let's say, Jimmy Buffett with the Margaritaville brand. That is more of what they're talking about there versus Alan's reputation in the industry as an attorney. If that's not one of the other businesses, then that wouldn't also catch him in number 11. So a lot of people were concerned about that. Maybe like a construction worker that was really high valued and had a great reputation would be caught in this category, but that's not the case. It only applies really to name, image, and likeness use for number 11. All right, so go through another example here just to kind of drive home this idea of what we can do is, so we have the client there over the threshold for taxable income, so there's no 199A deduction. Well, his youngest child is single, makes less than the threshold amount. If we shift income to that child and stay below the threshold amount, then they can take the Section 199A deduction, even though it's a specified service trader business. Same thing for child 2, who's married. They're below the threshold. They could also take the deduction, even though it's a specified service trader business. But the problem with that is the client doesn't want to give full ownership to his kids, have them have direct access to this money. It could be lost in a divorce. That's the last thing the client wants, is child 2 to get divorced, and now the ex-spouse has an interest in this entity that he's built his entire life on. Child 1 single, who knows who that child will marry, who knows what they might get into. So what can we do there? Can we use trust for this? And the answer is yes, but the bad news is we thought we could use trust a lot more liberally than we can under the regulation. So the initial thought was, yeah, let's just set up complex trusts, pay their own rate brackets, have 3 or 4 of them, take all the Section 199A deductions that we can, spray income across all the beneficiaries of the trust, and that'll be great. Well, the IRS put some anti-abuse rules into place that limited the ability to use these types of trust. They still have some utility, and you still can use them. You just have to use them in a more creative manner. You can't use them primarily for avoiding tax under 199A. They have to have some other non-tax purpose, which a lot of them you can come up with, whether that's estate planning, whether that's creditor protection. There's all kinds of reasons to create trust other than income tax savings. But to talk a little bit about using trust, the final regulations tell us that if we form a trust with a principal purpose of avoiding or using more than one threshold amount for calculating the 199A deduction, then that trust is really just aggregated with the grantor or the settlor of that trust, and therefore you don't get that separate threshold. No trust beneficiary or the trust would get a Section 199A deduction if it's the principal purpose. So what is the principal purpose? Well, we'll get there in a second, but let's go through an example first to drive home how the regulations kind of limit the ability to use this. So what we thought we could do was say, hey, we have a separately taxed trust with $300,000 of income from one of these specified service trader businesses. It takes $150,000 of that and gives it to a child or to a grandchild, what the trust beneficiary, whoever that is, with no other income. So that's a below the threshold taxpayer that can qualify for the deduction. And it retains $150,000, which means the trust pays its own taxes. It also has a threshold. So that's below the threshold and can take the 199A deduction. And that would have significant income tax savings. And that plan can be done as long as the primary purpose is not to avoid tax. So there's got to be some other non-tax reason for this. If the primary purpose was to avoid tax, then we aggregate all that together. So the 100,000 is added together, the 150 the trust retained is added together. That's over the threshold limitation at $250,000 of income for a single filer, and therefore you get no 199A deduction. So what is the principal purpose? There's been some case law on this. There's the Ditter Brothers case, that's first in rank, authority, importance, or degree. So we just come up with other reasons. The creditor protection is the primary reason, could be one. The estate plan could be another reason. Alan, can you think of other, reasons why trust might be used other than just to avoid tax?
Well, a lot of us represent clients who have trusts already. So if you think of your clients who already have irrevocable trusts that were formed by parents when they died, or credit shelter trusts that were formed by one spouse when that spouse died, they were not created for Section 199A purposes, as evidenced by the fact that they aren't used under 199A until after the formation. So that would be one example. In addition, most clients don't form these to save tax under 199A. They form them to save credit from creditors, to save from divorce, to keep a certain degree of control by being able to control who the trustee is. So it's a mixed bag, but there's a lot of opportunities out there. Now, Brandon, I have a question.
Mm-hmm.
If I form a complex trust for the purpose of avoiding 199A, and that complex trust pays out all of its income to my 3 children, and let's say it retains 50,000 of income, it pays out the rest to my 3 children. Is that 50,000 aggregated with my income for 199A purposes, or is the income that also went out to my children aggregated, or are the rules clear?
So all the income that goes out is aggregated. The kids would still pay tax on what's distributed, but as far as determining whether it qualifies for 199A deduction or not, what's retained in the trust, what's distributed from the trust, and what's retained in the grantor's own name is all lumped together, and you apply that to the threshold limitation, which if it's over the $340,000 for a married couple, then the trust, the beneficiaries, the grantor, no one gets the 199A deduction, but they all pay taxes based upon what was retained or distributed to them under the typical tax rules.
So 2 things. Number 1, don't give up hope, because we're going to tell you about Section 678 trusts that are not subject to this rule. Mm-hmm. And number 2, for those of you who are interested in grammar and jurisprudence, you can't say a principal purpose is this and have multiple principal purposes, because a principal purpose is the principal purpose. So when they wrote this, they may have meant, well, if one purpose was 678, but the other purpose was protection from divorce, but they were equal, or they were the top 2 principal purposes, then the rule would apply. But the definition of principal is first in rank. So just a little grammar. Maybe the people who drafted these regulations skipped the 4th grade, but I distinctly remember covering this in 4th grade.
Yeah, and under the proposed regulations, they even said that these trusts would just be disrespected, and no one really knew what that meant either. So they cleared that up in the final to make it a little bit more clear, but that was an interesting one as well.
And I think that those regulations came out the same day that Roberta Flack died, if I'm not mistaken.
Or Aretha Franklin.
Aretha Franklin died, that's right. And the word disrespected, by the way, in the South, it doesn't have a great meaning. You don't want to use the word disrespected. It has racial connotations. So I guess they didn't cover that in 4th grade either.
That's right. So yeah, another thing that you cannot do under Section 199A is use multiple trust. So there was a code section in around 643 for the longest time that mentioned this possibility, but had to have regulations enacted to make it effective. Well, they used Section 199A to issue regulations here and make this multiple trust rule come into play. And so the idea would be, I have an only child. I set up 3 trusts for that child, and therefore I have 3 separate thresholds. That's not going to work, because if they have the same grantor, the same beneficiary, and again, back to a principal purpose for creating the trust was to avoid federal income tax, then they're all aggregated together. You have, one trust, one threshold. You can't just create multiple trusts to get around these threshold amounts. So a couple of points here. If I set up a trust and my spouse sets up a trust, there are attribution rules that treat us as one person, so you can't do that and get around it. But if I have 3 kids and set up a trust for child 1, a trust for child 2, a trust for child 3, then that kicks one of the legs out of this 643 regulation. And as long as those aren't established for a primary purpose of avoiding tax under 199A, we don't get hung up with the multiple trust rule. So there's also good ways to get around this. One, don't have the same beneficiaries, don't have the principal purpose being avoidance of federal income tax, and you can avoid these anti-abuse rules and get some nice income tax savings each year. And we'll go through some examples as to how that works. So, Alan, any comments there before we go to the next polling question?
No, I'm excited to be at polling question number 2. Trusts will be aggregated as a single trust for Section 199A purposes if A, the trusts have the same grantor, B, the trusts have the same beneficiaries, C, a principal purpose of the trust is the avoidance of income tax, or D, all of the above. D is for dingo, arf, 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 with an Australian accent. Okay, very good. D was the answer, and my grade in 11th grade chemistry.
All right, so I'm going to go through one example that we put together for a client probably 2 or 3 years ago. So some of the numbers aren't based on the current tax rate, but based on tax rates that I think were in 2018. I do have an updated example to share with you on 678 trusts when we get there, but this one was more for a complex trust situation, and we felt comfortable enough that the trusts weren't set up just for income tax avoidance, so we were able to avoid those rules and put this plan into place. So we have a medical practice S corporation, pretty significant income, so clearly a specified service trade or business. So what could we do here? Well, first let me just zoom in on the medical practice side of things. This might be a little bit easier if it wasn't a medical practice, and there's some rules as to who can own medical practices in certain states. There's ways you can still use trusts to do that, but ignoring those rules for now, let's just look at the simple aspects of this. We have the medical practice, and we also set up a management company as well. I received a management fee, but now the medical practice has around 2.8 million of income, and we gave 10% each to these complex trusts. We also considered 678 trust, but the advantage of using the complex trust gives us some flexibility at the end of each year or 65 days into the next year to try to analyze what amount of income we could distribute, what would be appropriate for each child based upon their actual income and the income the trust received. So the $280,000 of income comes into this trust. We see that child 1, who's married with $100,000 of other income, can get $215,000, which was the $315,000 threshold at that time of income, and still be below the 199A threshold. The trust just retained the excess, so that could also qualify for the deduction because the trust is then below the income tax threshold, the 199A threshold. Another 10% to a separate trust for child 2. Again, not a multiple trust issue because different beneficiaries of these trusts. It retains 65,000, distributes 215 because the child has 100,000 of other income. And then we have child 3 who's single, no income. It gets a full 157,000, which was the single threshold in 2018, and retains 122,000. So at the end of the day, what we were able to calculate is that saved the family about $200,000 in income taxes each year, just by having these complex trusts in place, the ability to look up to 65 days into next year at the income level of each child, making a distribution of that income to kind of get them right up against that 199A threshold, retaining the rest in the trust and paying taxes at the trust level, but you get the 199A deduction. The parents were still in the highest rate bracket, so it didn't really matter about the compressed trust rate brackets that would apply here in this case. So this was a good plan we put together. A little aggressive, but having the complex trust, having the fact that they're not set up for principal avoidance of income tax, it was just an ancillary benefit that we were able to go here. So what if the medical practice can't be owned by these trusts? And that's where this management company came into play. We could keep the medical practice owned by the doctor, set up an arm's length management arrangement, and have income shifted to the management company, which can be owned by the trust. Alan, you want to talk a little bit about the dynamics of that and how we can structure that type of agreement?
Sure. Let me first just go back to the to slide 79, and if we use section 678 trusts here, then child 1 is considered to be the owner of 10% of the S corporation and pays tax on the K1 on 10% of the S corporation. But I want to emphasize that the 678 trust does not have to be only for child 1. It could be for Mrs. Jones and for the benefit of everyone in the family, and could spray income to charity, but child 1 is going to pay all the taxes on that. Now, when you draft that section 678 trust, you have to be really, really careful that it would not be considered to be a grantor trust considered as owned by the doctor, which means that Mrs. Jones cannot be a trustee of the trust. So you've got 3 different savings going on here. 1, you've got the 20% qualified business income tax deduction. 2, you are at child number 1's bracket, which is lower than the doctor's bracket. And 3, you're saving Medicare taxes because the doctor, if the doctor has the income, he's going to pay a 3.8% Medicare tax on that income. Child 1 is not. So that's why the difference could easily be what, $40,000 to $45,000 per child per year of savings. I also wanted to mention that if you're in Florida, then first of all, congratulations on dodging 2 hurricanes if you did. And thank you, Mother Nature, for allowing most of us to dodge those hurricanes. But secondly, if you're in Florida, the Agency for Healthcare Administration has said that you can set up this type of arrangement without having to register the medical practice under the Clinic Act, which means that you can set up this arrangement, but the doctor will have to be a trustee of a subtrust, which can be owned by the Section 678 trust or the complex trust. And if you're in Florida, if you ask for more information, we'll be glad to give that to you. So Brandon, before I go back to your original question, do you have anything to add to what I just said?
Yeah, I think one of the things, so really good question in here, could you review the requirements to keep the S election with the ownership by the trust? So that's a really good important point. There's 2 options. I think we talked a little bit about it in part 1 and we have some slides on it. If it's a 678 trust, you don't have to worry about it because the individual is then deemed the owner of the trust and is an eligible S corporation shareholder. So that's one easy way to do it. The second is the trust can make ESBT elections, ESBT for electing small business trust. The downside to those is that now you pay tax at the highest rate bracket, regardless of whether it's distributed or not, which was some of the assumptions that we made here as well, that S corp income would be still taxed at 37% rate bracket. But you get the 199A deduction, so it drops it down to, I think, 29.6 if I'm running the math right. The third option is a QUIST, which is a Qualified Small Business Trust. And the QUIST requires that all income received by the trust be distributed to an income beneficiary. So the downside to that one is you lose a degree of creditor protection in the trust because it can't accumulate income. It has to be distributed out. There's ways to kind of block the income. If you set up a QUIST with a blocker LLC in place to maybe help a little bit with that, but those are your options with trust as S corporation shareholders.
Let me just mention that normally you use a 678 trust, and that trust is disregarded, considered as owned by the child. But then you make an ESBT election as a belt and suspenders situation. So I'll also mention that, you know, some of you are texting or emailing us and saying, well, what about the kitty tax? Well, first of all, if you're a cat owner, maybe you deserve to pay a little bit of extra tax. But if you're talking about the tax on children or people under the age of, what is it, 26 or 23, who
Yeah,
I think it's 23,
yeah,
who get taxed at the brackets of their parents, you're still going to save a lot, because even if they're taxed at their parents' bracket, on the first $13,000 of income, they're taxed at their own bracket. And then you've got the 20% savings and the Medicare tax savings. And then there's a sly way around the kitty tax, and that is you give the kid a bunch of money and the kid pays more than 50% of their own support payments, and then there is no kitty tax. So now I know a couple of you want to see a tax on dogs, but that's not going to happen. Now, page 78. You may live in a state that doesn't allow medical practice ownership by a trust or by anybody other than a licensed physician. But in almost every state, if not every state, they are permitting profits from a medical practice to go into a practice management company. And in every state, to my knowledge, venture capitalist firms have entered into arrangements where they pay medical doctors for their goodwill, and in exchange for that, the medical doctor agrees to work in the practice for fair market value compensation and to allow the profits to go primarily to the medical practice management company. So let's say that this management fee is expected to be $1.2 million a year. So based on $1.2 million a year and expenses for running the management company, there's going to be $857,000 of income expected to go into this company. So the company may be worth 5 times that. The company may be worth $4,500,000. And a valuation report would be produced, and a long-term agreement for management and non-competes and employment agreements for the doctor get entered into. So now you transfer this $4,500,000 asset, 1/3 each, into 3 separate 678 trusts for the children. Now each separate 678 trust is going to get 1/3 of that income, a lot of income, so you don't have to give the whole 1/3. You could have the doctor keep 20% and go 10% each to the 678 trust, so they would each get about $86,000 a year of income. The 678 trust is also a spousal limited access trust, so it's for the benefit of Mrs. Jones and the descendants. So having made a relatively small gift and a small gift of a part of the estate tax exemption, the doctor now has all that income going out, taxed at the child's bracket, and available for the consumption of his spouse. And of course, you use a floating spouse provision if you like, if you represent the doctor but not the spouse, which says that if he remarries, the next spouse is a beneficiary of the 678 trust. So here you've got a lot of income tax savings and a lot of estate tax savings. And also, it's helpful from a creditor protection standpoint, because the management company can have a lien against the assets of the medical practice. and the ability to siphon the income from the medical practice. So now if the doctor gets sued for malpractice, the plaintiff lawyer has a lot less to glom onto. Now, there are Internal Revenue Code provisions that affect this type of planning. And if you like, we can send you an article that we wrote with Marty Shinkman and Jonathan Blottmacher on the use of these management agreements. But they certainly work, and they pay for themselves many times over.
Yeah, all really good points. So yeah, let's cover this next polling question before we move along and keep those rolling.
Okay, so what will be true in 2023? A, the estate tax exemption will be $12,920,000. The gift tax exemption will be $12,920,000. The annual gift exclusion is going from $16,000 to $17,000, and the correct answer is D, all of the above. And D is for donkey. What does a donkey say? Eeyore. Is that Eeyore was a donkey?
Eeyore.
I don't know. Eeyore. I think I'll drink a Moscow Mule for dinner tonight. Okay. By the way, there is no tax on donkeys, to my knowledge. All right. Brandon, do you want to talk about complex trusts, or we have 23 minutes left?
Yeah, I'll just briefly kind of hit the highlights here. Just some other advantage to the complex trust situation. Charitable deductions from the trust. If you draft for that to be, you have to specifically say that income can be paid to charity for the trust in order to qualify for this. But it's a nice way to shift some income out to charity. You can get a $10,000, another limitation for state and local income taxes. The 65-day look back period can be really beneficial, particularly for this type of planning where you can make distributions 65 days into the calendar year and treat them as having been made in the previous year, carrying out the distributable net income. So you can kind of see income levels of beneficiaries and spray income across lower brackets and making sure they don't hit the high bracket. You can distribute assets tax-free, fair market value basis, potentially if you give certain powers under the trust agreement. So all these have nice advantages under the complex trust. Few disadvantages: you do have to file an annual tax return for the trust. You don't get 179 deductions, but you can get the 168K bonus depreciation, which is often as good as 179. A few more restrictions might apply. So those are a few of the disadvantages there. Here's what Alan was talking about with personal service corporations. Make sure all these are done at arm's length. Make sure they're fair market value arrangements. You get some industry expert to help you out with setting the fees. You don't just make it up. Make sure you're doing that the right way. So now to more details on grantor trust, which are specifically excluded from some of the anti-abuse rules under the regulations. They say that the owner of the trust for income tax purposes will still be treated as the owner for 199A purposes, so you don't have issues with the anti-abuse rules of trust, because it makes sense. So it's almost the equivalent as giving it to an individual versus giving it to an individual that's considered as owning the trust. So what does that include? Grantor trust. So your typical intentionally defective grantor trust is included, but that doesn't really help you with 199A because then the client's still the owner for income tax purposes. The 678 trust, very beneficial, but again, the downside to 670, not the downside, but the trap with 678 is to make sure you're not otherwise treated as a grantor trust. If the grantor is a beneficiary, if the spouse is a trustee, if the spouse can receive distributions without consent from an adverse party, that's another one of the trust beneficiaries, then that trust will be a grantor trust. Even if you have the most perfectly beautiful drafted 678 trust there is, it's not going to help you because you're kicked back into the grantor trust rules. Now, 678 trust, how do you get the beneficiary to be taxed on the income? Well, you give them a power of withdrawal over the trust assets that's contributed. that power can be released as long as they otherwise have a grantor trust power. So for example, you give them 60 days to withdraw the 10% contribution of the entity to the trust. After that 60 days is over, or maybe before the 60 days is up, they execute a release of that power, and they have the right to substitute assets of equal value with their own. So now you have a release with the grantor trust power in the beneficiary, and you have a 678 trust. The other kind of common way to do this is a little bit more easier, is to give the beneficiary the power to withdraw all the income annually from the trust. So they have the power to vest the income in themselves, and therefore they are treated as the owner of the trust for tax purposes. Doesn't mean the income has to be withdrawn, it's just that they have that power.
So can I just mention another, I just find it so interesting. If you read a 678 trust, a person other than the grantor is treated as the owner of any portion of a trust with respect to which the person has a power exercisable solely by himself, but it could be women either, by the way, to vest the corpus or the income in himself. So does this mean that if I give my daughter the power to vest the income for herself, that the whole trust is considered as owned by her? Or does she have the power to vest her choice of the corpus or the income? And over 30 years after this section was added, nobody knows the answer to that question. Isn't that interesting? And also, if my daughter has that power and then she releases it, she's still considered to be the owner of that trust. So the safest thing is you say, I just put $250,000 worth of something in this trust. My daughter has 30 days to withdraw what I just put in, principal or corpus. If she doesn't exercise it, she can release it. She signs a release, and then she's released it. But now her creditors can reach into the trust unless I put the trust in an asset protection jurisdiction. Nevertheless, and the trust may be taxed in her estate. Nevertheless, it will not be taxed in my estate or my spouse's estate. So these 678 trusts can be a little bit finicky, or if you use somebody who wants everything to be perfect, maybe life can't be perfect. I know your life is perfect. Mine has not been exactly perfect. But there's a lot of reading there. We have a book, by the way, on 199A planning. It's at Amazon, and it goes into these 678 issues, or you could just Google Edwin Morrow, M-O-R-R-O-W, 678, and he has really good outlines on it. It's really, really interesting to geeks like me. Brandon, what's next?
Yeah, I'm going to share my screen and just go through an example here.
And that's good because Brandon doesn't always share.
All right. Let's see. There we go. Can you see that, Alan?
I can.
Okay, let me get the other one here. This is the one with the 678 trust. Okay, so this is going to be basically a little ditty about Jack and Diane. So Jack and Diane, they have a limited partnership and an S corporation, and combined they have around 1.2 million of taxable income. So clearly both of these are going to be, one's a consulting business and one is a financial advisory business. So clearly SSTVs. I think from an initial looking at this, something even outside of 199A planning that could be done is convert the limited partnership to an LLC and file an election to have the LLC taxed as an S corporation, pay Jack a reasonable salary, and maybe block some of these employment taxes that he's receiving. Because if we look at this and assume that, say, 600,000 of the income comes from Jack, that's all subject to employment taxes, self-employment taxes. That's around almost $40,000 a year that Jack's paying in employment taxes. So pay a salary and distribute the rest of the income not subject to self-employment taxes could be a nice savings tool as well. But as things are set up today, they're paying around $417,000 of taxes annually. So what could they do? Well, they have one son named John and one son named Cougar. They have 4 grandchildren, Mellencamp, and then Johnny and Debbie. So John has income. He's married about $110,000 of income. And we know the married threshold for 199A purposes is $340,000. So we set up a Section 678 trust, give around 19% of each entity, and I've just combined them here for ease of illustration as one entity. We wouldn't combine them. We want to keep things separate, but just to make the illustration easy, I put them together. So 19% of 1.2 million is around $228,000 of income. That gets John $338,000 of total income, well below the $340,000 threshold. So he can take a Section 199A deduction, and there'll be some tax savings there. In addition, now 20% almost of the entities outside of Jack and Diane's estate. Then we have Cougar. He has $300,000 of income, a little bit more of a high earner, so Cougar can't receive quite as much. Around 3.33% could go to him. $40,000 of income when added together with these other income, still below the threshold. We can get a little bit of Section 199A tax savings with a small deduction for Cougar. Then we do separate 678 trusts for Mel and Camp. And again, for ease of illustration, I've just combined them together in one trust here. Their grandchildren, no other income. So I did 7% each to each of these trusts, which give each grandchild around 84,000 of income. I could do all the way up to 14%. That would still keep them under the threshold, but then that would take away from what Jack and Diane are retaining, and they wanted to keep around half to support their lifestyle. So Mel has a 678 trust. Assets go in. Mel has a withdrawal power to withdraw those assets. It's not exercised, so they stay in the trust. It's released, and Mel is now the owner of the trust for income tax purposes. Same thing for Johnny and Debbie, 7% each, 84,000 of income. So what does that look like at the end of the day? So Jack and Diane kept around 50%, so they have around $600,000 of income. Income taxes on that is around $150,000, plus employment taxes on Jack's share of the limited partnership income. Total taxes $183,000. Net after tax income $412,000 are left for them to live on. John's trust gets qualified business income of $228,000. That's not now in Jack and Diane's income tax liability. Gets a 199A deduction. Taxable income at his effective tax rate is around 37. Cougar, same thing. His taxable rate is 20.35%. Now, Mellencamp and then Johnny and Debbie, they have Section 678 trust as grandchildren, but they're minors. They don't support themselves. They have no other income. So the kiddie tax does apply here, but it's based on John and Cougar's rate brackets, and it's their top marginal rate. So we went ahead and put their tax rate at 24%, but take the 199A deduction with respect to the income that passes to them. So now the total family is paying only $290,000 of taxes. So they went from 417 to 290, which is around $125,000 of tax savings each year. And on top of that, we'll have to file a gift tax return reporting the value of these entities, but it's minority interests, so they can be discounted. And so therefore, we've been able to pass around 50% of the entities outside of Jack and Diane's estate, and future growth of those entities also outside of Jack and Diane's estate, on top of the $125,000 of income tax savings that we can have here in this scenario. So Alan, any thoughts, comments on that illustration?
Thanks, Brandon. What is the Medicare tax savings? Do you have any estimate of that?
Yeah, so they went from paying, let's see, that's the wrong one, 27,000 after 199A planning from 38,000, so around $11,000 each year. And that's
Okay.
not on top of if we converted it to an S corp and did some planning there. So there could be even more savings in that regard.
Okay. One question, we didn't reduce the tax bracket of Jack and Diane, right? We didn't get them, they're not getting a 199A deduction. We didn't get their income low enough.
That's right. Yeah, they're still paying taxes at the top rate bracket. Because even though this is slightly below the top rate bracket for a married couple, they have other sources of income, capital gains, interest, dividends, that's going to probably push them up to that top rate bracket. So we just assume that it would all be at the top rate.
Yeah. What would be the pros and cons of giving a 678 trust to their parents?
That could be done as well. Yeah, absolutely. Can't think of really any cons other than they're just, giving up more of what they have. We wouldn't want to make them broke and make sure they could continue to support their lifestyle. But yeah, if they had 400,000 they thought was plenty, they only needed 200,000, then a separate 678 trust for mom and dad could be added in as well.
Right. Okay. I thought that this was a very good exercise. This was actually an exercise done at the request of a financial advisor this week. So it's always, fun to be able to show some of the work that we do in these Saturday webinars. And Brandon, you did a great job on this.
Yeah, thanks. That was definitely an interesting plan. And again, these trusts are set up primarily for probably 199A planning. Yeah, there's other benefits here, but it's a 678 trust, and it would be just the same as if we gave it to John and Cougar individually. So no issues with the anti-abuse rules. Another part of this is Diane could be a beneficiary of some of these trusts, or Jack, depending on which spouse you wanted to favor, and it could be a 678 spousal limited access trust. So that's another piece of the puzzle as well.
Okay. And then Brandon, I have a question. What would it take to make this into a calculation type of spreadsheet that would be really easy for a tax advisor to use to make similar calculations and show their client how this works? How long does it take you to do this?
This one took about 2 hours to put together. The hardest part is, calculating the taxable income. With the progressive rate brackets, it's not just, a flat 24% tacked on. So that's where it gets a little bit tricky, depending on, what rate bracket people are in and how to calculate that. And, running the numbers there is the hardest part, but it could probably be integrated into some sort of automated type of spreadsheet. It's doable.
Now, yeah, Eric has a good, and by the way, the circles and lines are all part of Excel. So in an Excel document, you can put your circles and lines and your numbers showing what's going on. Now, here's a good consideration from Eric, and that is, what do you estimate is the change in the cost of compliance for something like this? Probably not as much as one might think. If the client can be trained to open accounts under each trust and actually make the distributions and decide what to do with the money under each trust, you're not going to have a separate, you're going to have just reporting returns for each 678 trust, right? Like a letter of disclosure to the IRS.
Like a grantor trust information type letter that, all this K1 income that's allocated to this 678 trust is reported on John's personal income tax return under John's social security number. It's kind of the extent of the tax return for the 678 trust.
Right. Now, Karen wants to know, is Brandon's Excel example in the slide deck? And that's no, but we'll send it out to everybody. And by the way, yes, there are compliance costs. There's legal fees to set it up, and then there's accounting fees and hand-holding of the client, but at least all that is pretty much income tax deductible, or the tax compliance fees would be, whereas paying taxes is not tax deductible. And if the client is in one of the states that imposes an income tax, then the tax savings will be greater. And for this particular family, there's going to be a lot of estate tax savings. So then another good question is, what do you do when the 199A exception goes away? How do you get rid of these trusts? Well, my first answer is you may not want to get rid of them. They're still serving a good purpose for estate tax and creditor protection planning. But if you had to dissolve the 678 trust, you could. You can have the trust protectors have the ability to direct the trust assets to one or more of the beneficiaries, which could include Diane in this example, or 2 or 4, the benefit of the children. And then Stewart says, who are the trustees of the trusts, as the spouse and grantor cannot be the trustee? Well, typically the child will be the trustee, and they'll continue to be the trustee as long as they do exactly what Jack and Diane suggest that they do. And as soon as they don't do that, then they may find that a trust company or the lawyer or the CPA or Jack and Diane's best friend may become the trustee. So, Brandon, do you see any other questions that you want to answer? Because we have a lot of good questions here. Or is there anything else you want to cover? You've got about 3 minutes left, which for most of our participants is about 2/10 of a billable hour.
Yeah, I don't think we have time to cover anything else. There's a lot more slides. I think because some of the more interesting slides that are left relate to basically what we call pseudo SSTBs, where you would set up like that management company and try to shift income there that wouldn't be treated as an SSTB, and the regulations prohibit that. You can't just move income over, but there's some creative stuff you can do maybe with ownership of that entity to get outside of those rules. So maybe we could cover that part in a part 3, but that's really the rest of the slides. And let's see, what do we have here?
We have poll. Go to 132 and they'll do the last polling question.
There we go. Yeah.
Brittany just reminded me of that.
Let me turn off my screen, give it back to you.
A little sound effect for your enjoyment.
There you go.
All right, 132. Thank you, Brittany, for babysitting us today. And Brandon, we do have a lot more slides, so we should do a part 3.
Mm-hmm.
And by the way, for participants, if you could let us know what you would like to see webinars about, like how to do puppetry, the tax deductibility of a puppet, more on charitable income tax planning, please send us a email or just type it right into the spreadsheet and we'll take a look at it. But which of the following topics would you like to see a presentation on? A, year-end tax planning for the wealthy. Oh, that's next week at 11 a.m. So if you chose A, you're in good shape. B, charitable planning, which is a big interest that we've been working hard on a charitable planning book in the last year and a half. C, estate tax planning techniques. D, mathematics of estate planning, or just tell us anything that you would like to see a presentation on. Okay, so we finished in time, which is what we always aspire to do. Please stay tuned for future Saturdays. There was one question on where can you learn the basics of 199A. If you Google Gassman Ketron 199A YouTube, you'll find YouTube videos that hit this on a more basic platform. I really like our book on 199A because it covers a lot of the income tax basics that we thought laymen would need to know to understand how the system worked. So anyway, have a fantastic rest of your day. Hope this helps you. You will get an email in 2 or 3 hours where you can click to see a replay and you'll get our spreadsheet. And then if you can forward that to everyone you know on the whole face of the earth, then you can share this information. We hope it's been valuable. Brandon, thanks again for leading this discussion. Have a fantastic rest of the day.